G'day and welcome to this week's video. My name's Robert Gowdy and I've got
Amy Lehman.
G'day Amy. We just completed a podcast on looking at the alternative where people pay extra money off their home loan, and instead of using that to pay off the home loan, that money is sacrificed in pre-tax dollars into your superannuation fund. And we thought we'd go through the quick benefits of doing that. Amy, do you want to kick off?
The number one benefit is the tax saving that you get when you salary sacrifice into super rather than take that money as take-home pay and put it onto the mortgage. Now, most Australians, the average tax bracket is the 34.5%. So putting it into superannuation instead via salary sacrifice goes into super at 15% as opposed to that 34.5%. So you are essentially having 19.5% saving on that money going in rather than receiving it as take-home pay. So that's a huge, 19.5 cents on every dollar saved going into super.
Day one, so a huge tax benefit.
Yeah.
The other benefit is that money is invested into superannuation, and then you get the effects of compounding interest over a long period of time. Now, the timing of when this happens is, possibly people in their 20s and 30s, preservation age when you can access your super, and that's when you can perhaps draw down on your super to help pay off your home. It's probably a little bit too far away, but people in their 40s and definitely in their 50s can definitely use this, and then you are retired for a very long time. So you get the benefit of not only the nearly 20% tax saving for people on a marginal tax rate of 34.5, but you also get the benefit of compounding interest over a long period of time.
Yeah.
And whilst it's inbuilt with us to pay down our home loan, that can wait and that can be paid off down the track. And it really doesn't matter, your house will still go up in value regardless, depending on the market, but it doesn't matter what our house is worth. That's our home. We're not there for income, we're there for somewhere to live and a place that we love.
Now, there are also some cons to this strategy, and that is definitely your access to funds and that retirement timeline. So for someone such as myself, mid-20s, I know I've got 40 plus years until I have access to my superannuation funds before I can withdraw that and pay down the mortgage debt that I might still have. But if you are someone in your 40s and 50s, you are closer to retirement, so this strategy is more appealing to you, but that's just something to keep in mind. Preservation age is 60, and if you've stopped working, then you've got full access to your super. But if you continue to work, you've got 65 is the age that you can access the super, so just remember the restrictions on withdrawing your money.
And probably another downside is that when you put money into super, you get volatility. We're seeing lots of volatility over the last few years. We're seeing volatility at the moment in the share markets, so that means that your money can go down with markets. But remember, people that are age 50, there's every chance that they'll be invested and retired for up to 20, 30 years. But we probably need to think about when you might need to take out the lump sum to pay off the home loan if you haven't been paying extra off and getting that big tax saving each year.
Yeah.
So that's one to think about as well.
Yeah, definitely. But if you want to come in and have a chat with us, we're happy to go through the strategy with you and put it in your personal circumstances terms. But aside from doing that, just keep in mind this is general advice only. We're not telling you anything to do. We don't know your personal situation or your objectives. So take that on board.
Fantastic. Thank you for listening.
Thank you. Bye.